Reaching your financial goals is about more than choosing the right investments. It's also about giving back as little of your gains as possible come tax time. So let's find out how to grind our tax bills lower. In this episode, a financial planner shares his tips for tax efficient investing, from picking the right investing accounts to holding the optimal investments in each of them. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. Joining us is Jason Heath, Managing Director at Objective Financial Partners. Jason has been offering fee only, advice only financial services for over 20 years. Jason, it's great to have you here with us. Thanks for taking the time.
Thanks for having me, Brian.
Well, Jason, some of our viewers may recognize you because I think you're a little bit of a celebrity in the financial editorial world. So you have a popular columnist for publications like the National Post and Money Sense magazine. What drives you to share your knowledge with your readers?
It's interesting because if I go way back in time to before I went to university, I applied to study journalism at Carleton in Ottawa. I think at the time it was the only university degree you could do in journalism. And so I almost went into the field and ended up studying economics instead and got into the financial industry. And I've sort of come full circle and become a journalist without the training. But along the way, I almost reconsidered a different path. I applied to teachers college. I was going to potentially be a teacher, and I kind of feel like I am with my clients and with my readers. So, all of my past passions I've brought together and wound up in this career that gives me a lot of fulfillment.
Oh, amazing. Yeah, I like the teaching path myself as an instructor. It kind of seems to go that way where you like to share that knowledge. So one of the things we're going to talk about today is taxes. So, wise man once said, the only two things certain in life are death and taxes. And I think tax questions are a frequent focus of Canadian investors. And while they're important, you feel that tax efficiency shouldn't be the driving force behind investment decisions. Why is that?
If you put tax efficiency ahead of prudent financial decisions, whether it's, should you be investing in the first place or should you be paying down debt, security selection, building a proper portfolio, you might end up sacrificing more important things for the expense of saving tax. And, one example that sort of rings true for me is Canadian dividends. Canadians love their dividend stocks, dividend focus. They're taxable at a lower tax rate than other forms of income, and we're going to get into that later. But Canadian stocks as well, they're pretty narrow. Half the Toronto Stock Exchange is banks and energy, so you miss out on sectors like technology, healthcare. So again, it's a big picture thing. Tax is important, but it shouldn't be the main thing.
Well, yeah, we're definitely going to hear a lot more about taxes, which I'm excited for that. All right, before we get into our conversation, just a quick note to our viewers that we're going to discuss some tax strategies and considerations that Jason feels can make sense for investors in general. However, each investor's financial situation is unique and some may not make sense for you. So take our discussion as food for thought rather than financial advice that works for everyone. Consider speaking with a financial planner if you have questions about your own portfolio. With that said, let's get into it. All right, first off, Jason, I want to let's lay a little bit of groundwork about investment taxation. How might different types of investments be taxed in Canada?
So just to go through them, I guess, interest, most people are familiar with interest income, whether you buy a bond or a GIC or you have a savings account, you buy an exchange traded fund or a mutual fund that owns fixed income securities. Generally, in a taxable account, you're going to receive interest income, which is fully taxable at the same rate as employment income or pension income or any other form of income. So interest-bearing investments tend to be the least tax efficient in a taxable investment account. Canadian dividends, referred to that earlier, Canadian eligible dividends are dividends that are paid by publicly traded companies. These dividends get a special tax treatment. They receive a dividend tax credit that reduces the tax payable to the investor. And generally speaking, the tax rate is, 10 to 20% less than what you'd pay on interest income, but it really depends on your tax deductions and credits and It's a little bit complicated, but the point is dividends are generally taxable, Canadian dividends, at a lower rate than interest income. Other types of dividends that are earned from foreign stocks, whether it's US stocks or stocks outside of North America, whether you earn them through owning those investments directly or through a fund, are taxed at the same high rate as interest. Capital gains, sort of the holy grail, so to speak. If you sell an investment for a profit, whether it's a stock or whether it's a business or a rental property or some other sort of asset, you have a profit, one half is taxable and one half is tax free. So the result is a capital gain is taxable at half the rate of a dollar of interest income or employment income or other forms of income. I think it bears mentioning the federal budget in April introduced new rules around capital gains taxation that has to do with the inclusion rate. Again, how much of the capital gain is included in income. And for most people listening, an individual taxpayer would need to have more than $250,000 of capital gains in a single year to be impacted by the new capital gains inclusion rules. Somebody, the corporation, is going to be impacted from $1, assuming that the new rules are passed into law, such that 2/3 of a capital gain is taxable instead of one half. So some capital gains changes pending. Last but not least, less common, if you own an investment that pays return of capital, which you might see with like a REIT, a real estate investment trust, a return of capital is actually a tax-free payment that gives back to you some of your original money and grinds down your adjusted cost base on the investment so that eventually when you sell the investment, you've got a larger capital gain. So kind of a neat function. Again, not common for most investors, but it's a form of income, tax-free income that you will come across.
So for you were saying for the individual investor, probably not a lot of impact on those changes that just came through recently when it comes to capital gains. There's still a really favorable taxation, right?
I don't really know. For an investor in particular, I think the key is if somebody has, even if somebody has a large multi-million dollar investment portfolio, a taxable non-registered account, generally speaking, you're in a position where you can choose how much of an investment you sell in any given year and try to stay below that $250,000 limit. I think it's more impactful for people who own an asset that cannot be sold in pieces, like a rental property. You can't sell a brick, you got to sell the whole property, or a cottage or a business, for example. So more impact in those cases. And again, corporations right from $1, at least as the proposals stand, would pay a higher tax rate or a higher inclusion rate and a higher tax rate on a capital gain.
All right. Well, that being said, now that we know some of the ways things would be taxed, where an investment is held can greatly influence how it may be taxed. So, how might investments be taxed within different investing accounts?
So a registered account, like an RSP, for example, has special tax treatment from the Canada Revenue Agency. When you own an RSP account, your contributions are tax deductible. The investment income and capital gains are tax deferred with an asterisk, and we'll get to that. And then your withdrawals are fully taxable. Registered accounts, there's a new registered account, a tax-free savings account at TFSA, where your contributions are not tax deductible the same way as they are with an RSP, but all subsequent income and capital gains, again with an asterisk, are tax-free. Withdrawals are tax-free. They're generally tax-free accounts. And I think that, as it relates to non-registered accounts, the important thing to know is that there's no special tax treatment. You're not getting a tax deduction. You're reporting the income on your tax return every year. You get a T5 slip or a T3 slip, or a summary of transactions to report it and to pay income tax. And for the most part, people's non-registered accounts include a cash account or a margin account with a brokerage. Or you might have a share purchase plan, for example, if you work for a publicly traded company. Generally speaking, You probably want to max out your registered accounts, your RSP or TFSA, before you're starting to build a taxable non-registered portfolio. But lots of moving parts and, dependent on the individual's circumstances.
Okay, Jason, let's get into some of those tips you have for building a tax efficient portfolio. The first tip is to max out lifetime contributions to a TFSA. Why might this be beneficial from a tax perspective?
Funds that you put into a TFSA grow tax-free. They can be withdrawn without any tax consequences. They're super flexible. It doesn't need to be tied to retirement. You can put money in a TFSA for a year or for 50 years. You can use it as a short-term savings vehicle or a long-term retirement account. I think one of the interesting things that I notice about TFSAs is that a lot of people just sit on cash in their TFSAs, which probably doesn't make the most sense if you've got a long-term time horizon. And again, you're trying to take advantage of that tax-free compounding. I mean, interest-bearing investments and safe investments have their place, but I think if you're going to try to take advantage of that tax-free growth, ideally you want to earn a higher rate of return. Lots of reasons that tax efficiency, if it's the first thing you're focused on, you may miss other opportunities like long-term compounding or more efficient use of your money paying down debt.
With these exceptions to every rule of thumb, what are some situations where an investor might want to prioritize another investing account over a TFSA?
If somebody is earning, a moderate or a high income and they're able to put money in and claim a tax deduction now, and then hopefully allow the money to grow and compound and take the money out in the future at a lower tax rate, generally an RSP is going to beat a TFSA. Another example that comes to mind is, again, I referenced a stock purchase plan. You work for an employer who's got publicly traded shares, multinational company, for example, and they incentivize you by matching 50 cents on the dollar, of money that you put into the non-registered investment plan that they offer. It might make sense to take advantage of that to get the 50% matching contributions from your employer.
All right, well, let's build on our RSP discussion with your second tax tip. So that's to avoid letting an RSP grow too large. How might having a lot of money in a tax sheltered account like an RSP backfire on an investor?
Yeah, RSPs again are great because they give you tax deductions, they give you tax deferred growth, but eventually those withdrawals are fully taxable. The same way a dollar of employment income or pension income or rental income is taxable to you. And maybe just to start at the start, an RSP you need to use by no later than December 31st of the year that you turn 71 to either purchase an annuity from a life insurance company, which is kind of like buying a pension. You receive a monthly payment or quarterly payment or yearly payment for life. Not common these days. Most people convert their RSP into a registered retirement income fund, a RIF. RIFs have mandatory withdrawals that increase each year, starts at about 5.28% and goes up with each passing year. If an RSP grows too large, the mandatory withdrawals would also be high and could push an investor into a larger tax bracket. More commonly, the way that I see it is people who retire at 60, they don't need to take RSP withdrawals until they're 72. And there's an opportunity in their 60s to potentially take some withdrawals rather than letting their RSP grow. If you die at a young age, your RSP is fully taxable in the year that you die, unless you leave the funds to your spouse. But certainly on the second death, if you're leaving it to your kids or to another beneficiary, it's a big tax hit. There's government benefits in retirement. If you're a low income individual, there's the guaranteed income supplement, GIS. If you're, a typical Canadian, you'll receive old age security, OAS pension. Tax savings this year is important, but I really think it's important to focus on lifetime tax minimization.
All right, Jason, we've touched on some foundational considerations with investing accounts. Now let's get into details of how to optimize investments within them. Your third tax tip concerns the RRSP. Which investments might it make sense to prioritize within it?
So I think in an RSP, generally it makes sense to consider holding Canadian and US or other foreign interest-bearing investments like bonds and GICs if you're going to own them somewhere. The main reason being that they're the least tax efficient to hold outside of an RSP, as we referred to earlier, fully taxable income. Also, in a TFSA, which you kind of want to grow as big and tax free as possible, interest bearing investments probably aren't going to get you there. So if you can choose to hold fixed income either inside your RSP or outside your RSP, I'd choose inside your RSP. And if you can grow your TFSA or non-registered account as big as possible, relative to your RSP, I think that would also be more beneficial since those RSP withdrawals are fully taxable. US stocks also work really well inside an RSP. There's a neat nuance. US stocks normally for a Canadian investor have 15% withholding tax on the dividends that goes straight to the IRS. That's your final tax obligation. As long as you're not a US citizen, you're just a regular Canadian resident taxpayer. But the US recognizes the tax deferred status of an RSP account. They waive the withholding tax on US stocks that are held within it. So that's an advantage or an opportunity to potentially hold US stocks or have a tilt towards US stocks in your RSP account if you have a choice of where you're going to own them.
Well, so those are some investments that can make sense to hold within an RSP. But what about the flip side? Which investments might not make sense within an RSP from a tax perspective?
Canadian dividend stocks can be less than optimal or less advantageous, I suppose, to hold in an RSP. In large part because, again, if you've got options, if you've got a non-registered account that's taxable, you've got a TFSA, you've got an RSP, that Canadian dividend income will be eligible for the dividend tax credit in a non-registered account, gives it special tax treatment that US stocks or foreign stocks, for example, don't get. So again, you might hold more US stocks in your RSP, more Canadian stocks in your non-registered account, your TFSA, for example, if you have multiple accounts and you've got options available.
All right. Well, you mentioned dividend taxation. That kind of piqued my interest there. And that can get pretty confusing. So I was wondering for our audience, can you clarify how the Canadian dividend tax credit can maximize the tax efficiency of holding dividend stocks?
The dividend tax credit for most investors who are investing in publicly traded companies, if you get $100 of Canadian eligible dividends on your tax return, it actually gets grossed up by 1.38 or 138%. So you'd receive or you'd report $138 of taxable income. So you might notice your T5 slip or your T3 slip, depending on the case. You might have $100 of dividend income, but you're reporting $138 of taxable income. And it's meant to loosely represent the pre-tax corporate income that the company earned and paid some tax on before paying you that $100 dividend. So you report, again, $100 of Canadian eligible dividends. You report 138 of taxable income on your tax return. On the flip side, you get a tax credit of 15% of the grossed up dividend, or about 21 bucks, that reduces the tax you owe on the dividend. Kind of confusing, but the result is that you end up paying less all-in tax on $1 of Canadian dividends as compared to $1 of US or foreign dividends or interest as well, for example. So a little bit of a tilt in favor to incentivize a Canadian investor to own Canadian dividend paying stocks.
Yeah, I think there's lots of videos out there, and I think we may even have some on Webroker that explain it in a lot of detail. But my opinion too is you don't need to know all the math around it. You just know it's more advantageous for the Canadian dividends.
Yeah, to make your head spin. And depends on the income level as well. So interestingly, at a relatively low income, you can earn a lot of eligible Canadian dividends and pay no tax. And there's even some levels of income in some provinces where you can pay, believe it or not, negative tax. Earning Canadian dividends can actually reduce your tax on other incomes. So definitely a unique topic.
All right, okay, let's move on to your fourth tax tip, Jason, which focuses on the TFSA. So which investments might it make sense to prioritize within it?
Generally, I think it can make sense to hold Canadian and US interest bearing investments in a TFSA if you have a short time horizon, if you've got money that you need or want for a specific purpose. I think sheltering that tax inefficient interest income from tax is better than holding it in just a regular savings account. I think if somebody has a longer term time horizon, holding stocks in a TFSA, and certainly Canadian stocks work quite well because the dividend, although it wouldn't be eligible for the dividend tax credit, it doesn't matter because the dividend as well as the capital gain is completely tax free. Canadian dividends are the only type of dividends that you can earn that do not have withholding tax in a TFSA. It's worth mentioning. Generally, US and foreign stocks will have some level of withholding tax on the dividends when you're owning them in a TFSA. The trade-off is arguably there may be more opportunities for growth or just diversification holding other types of investments. So again, don't just focus on Canadian stocks in your TFSAs. Investments that are expected to produce significant capital gains would be good candidates for a TFSA. It can be difficult sometimes to know which of your investments are going to be winners and which are going to be losers. Obviously, you expect them all to be winners, but I think if you expect to have big capital gains, earning those in a TFSA can be advantageous.
Yeah, those are some great nuggets related to the TFSA and what you should put in it. But conversely, which investments might not make sense to hold within a TFSA from a tax perspective?
If you're going to have capital losses on an investment, if you lose money in a TFSA, you don't get to claim a tax deduction. You don't get back that TFSA room. By comparison, if you own an investment and you incur a loss in a non-registered account, a cash or a margin account, a taxable account, you can claim that loss against other capital gains in the current year, in the previous 3 years, or carried forward to use against capital gains in the future. So just be careful about being overly speculative, penny stocks and, junk bonds and more speculative stuff. I lean towards holding that in a taxable account. Generally, it may not make sense to hold foreign interest-bearing investments in a TFSA. So, a U.S. bond or a U.S. bond fund, especially if it owns, foreign investments, a global bond fund, anything that holds foreign, non-North American investments, you have to be careful about because there will often be withholding tax on the interest that's being earned. And at the end of the day, if you're earning interest on a foreign bond or a Canadian bond, there's probably not going to be a significant difference in your return. But in a TFSA, if you're going to have withholding tax on a foreign bond, you might opt for Canadian interest-bearing income instead. I think it can be less advantageous to hold US and foreign stocks in a TFSA. As I mentioned earlier, there is generally withholding tax on all stock dividends other than Canadian dividends in a TFSA. Typically, the withholding tax is 15% for US stock. It can be upwards of 25%, typically 15 to 25% for foreign stocks. But again, if you're looking for diversification, you're looking for growth, should you avoid non-Canadian stocks altogether in your TFSA? No, but again, if you have opportunities to shift certain types of investments around and have more in one account versus another, I think it's important to look at your accounts as a single portfolio and then consider some tax efficiency.
Well, going back to that US stocks and dividends that you just mentioned, let's say if an investor bought an ETF or mutual fund that holds US stocks, would they be able to avoid the withholding tax on dividends the fund earns?
So it depends. In an RSP account, only if they bought US stocks directly that traded on a US exchange, or if they bought a US listed exchange traded fund, so an exchange traded fund that trades on a US exchange that owns US stocks, then the dividends would be exempt from withholding tax for a Canadian RSP under the tax treaty. Conversely, if you were to buy Canadian listed US stock funds. So whether it's a TSX listed ETF that tracks the S&P 500, or it's a Canadian mutual fund that owns US stocks, those investments themselves are considered taxable Canadian residents. So before a dollar of US dividend income even hits those funds, those investment funds, there's 15% withholding tax that comes off the top. The trade-off is that in order to buy US dollar denominated investments, you need to own US dollars. So there may be currency conversion costs to consider. But if an investor is investing for the long term, the currency conversion can be worth it.
I had no idea about that on the funds. That's another one of those asterisks, right? That we we
Yeah,
should be aware of.
lots of nuances for sure.
So the last tax tip we have, we don't want to give all the attention to the registered accounts. The last tax tip concerns non-registered accounts. Which investments generally make sense to hold in these accounts?
So I think it can make sense to hold stocks generally in a non-registered account. Again, because so much of a stock's return, for the most part, will come from capital gains, and we talked about how capital gains are the sort of the holy grail, the most efficient of all the forms of taxable investment income that you can earn. Canadian stocks benefit from that dividend tax credit that we talked about and have a lower tax rate than foreign dividends or interest. I think more speculative investments, again, work better because capital gains are tax favored. And if you happen to take a risk and lose, so to speak, those capital losses can be claimed against capital gains, something you can't do in your registered accounts. Certainly not recommending that you buy speculative investments just to pay less tax, obviously. But if you're going to do it, I would lean towards a non-registered account over an RSP or a TFSA. I think it can make sense in some cases as well to shift things towards lower yielding, higher growth stocks in a non-registered account. So just to give you an example, if you had a choice between, or if you were planning, for example, to buy a bank stock and a tech stock, a bank stock is typically going to pay a higher dividend. In Canada, tech stock is typically going to pay a lower dividend, may not pay any dividend. I might lean towards holding the tech stock in your non-registered account and the bank stock in your registered account. We talked earlier about return of capital. A taxable investor might be able to buy certain types of exchange traded funds, mutual funds, or frequently real estate investment trust REITs that pay a return of capital or a tax-free distribution that reduces your adjusted cost base on the investment, and eventually you pay tax on the capital gain, but that might not be until many years down the road.
All right, so that's the upshot of the non-registered accounts from a tax perspective. But which sorts of investments might it not make sense to hold in them?
Well, look, I think, Brian, first I'd start with, should you be investing in a non-registered account in the first place? And again, you probably want to max out your RSP and your TFSA before building a non-registered account. Might be an exception if you're a relatively low income investor and you've maxed out your TFSA, but it might not make sense to contribute to your RSP because you could actually pay more tax with withdrawals later. But I think ideally stocks earning deferred capital gains, capital gain generally does not get taxed until you trigger or sell the investment and cause the capital gain to become a current year capital gain. So stocks with capital gains, stocks paying Canadian dividends are preferable to, say, interest-bearing investments in a taxable account. But I think the other consideration is if your time horizon is relatively short, if you're saving for a car, if you're about to retire next year, from an investment risk tolerance and asset allocation perspective, it might make sense for you to hold interest-bearing investments in your taxable account, even though from a tax efficiency perspective, it's not your ideal choice. So take taxes into consideration, but also step back and take a look at the big picture.
So I think that's about it, Jason. So just a quick reminder to our audience, if you'd like to learn more about tax strategy, check out a recent episode called Fixing 5 Tax Mistakes That Can Cost You Money. Plus, we've got plenty of other episodes on tax considerations in the Learning Center on Webroker and on TD's YouTube page. All right, Jason, we're going to have to leave it there. Thanks for sharing the ins and outs of tax efficiency investing with us. Any thoughts you'd like to share with our viewers?
One thing that I often encourage DIY investors to be aware of is if you've taken on the responsibility of managing your investments on your own, there's more to it than that. There's tax, obviously, the topic for today. There's retirement, there's estate, there's other implications that you need to be mindful of as well. So you need to commit to learning about those things also, or, find somebody who can help. I think it's important to know the implications, important to consider them. Don't let tax be the primary influence, but you can only spend your after tax income. So your pre tax income, while it might be nice on paper, the key is how much of your income you keep that you can use for more important stuff.
All right. Well, thanks again so much, Jason, for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time. Have more questions? Check out the links to the right and in the description below.